Good afternoon, everyone. Thank you for registering and joining us on today's webcast. We're seeing a lot of people still joining the call, so we're going to give it another minute or two, but we'll get started underway very shortly. All right, I think we're ready to start. Good afternoon, everyone, and welcome to today's webcast with Investors Business Daily. My name is Graham Day. I'm with Innovator ETFs, and I'll be moderating today's call. First, we wanted to thank you for taking time to join us on today's webcast. We know the last few days in the market have seen extreme levels of volatility. So we appreciate you taking the time to join us today. We think that today's webcast will be relevant given the market volatility that we've seen over the last few days. Our discussion with IBD will revolve around staying invested in the markets and utilizing rules-based strategies that can remove the emotion that goes along with investing, and oftentimes the emotions that lead us to making poor investment decisions. So we'll be touching on both those items with Investors Business Daily today. We're also excited. We've got a few timely ideas given what's going on in the market, so we'll be sharing those with you. Before we kick things off, just a couple housekeeping items that I want to make you aware of. There will be a survey at the end of this webcast. It is an opportunity for you to tell us which IBD strategies you think you'd like to see in an ETF going forward. So make sure you stay tuned and fill out that survey when we end today's webcast. If you do have questions during the duration of this webcast, you can submit those questions on the browser, the lower portion of your browser. We'll answer as many of those questions today on the webcast, and any questions we're not able to get to today, we'll be sure to follow up with you after the webcast. If you have any questions, feel free to reach out to us at info@innovatoretfs.com, or you can call us at 800-208-5212. Moving along, I wanted to introduce our speakers today. I'm joined today by Bruce Bond, who's the CEO and founder of Innovator ETFs. Prior to founding Innovator, Bruce was the CEO and founder of PowerShares ETFs. And joining us today from IBD, we've got two guests, Chris Gessel and Justin Nielsen with IBD. Chris is the Chief Content Officer with IBD, and Justin is the Market Research Director. As we move forward and just look at the agenda, we got a lot to cover, so I'll keep this short. But IBD has been around for a long time. They date back to the 1960s, but we think IBD brings something that's truly unique to the indexing and ETF space. And we want to make sure that you're aware of the relationship between Innovator and IBD, where Innovator has brought ETFs that track strategies that have been built by IBD over time. We want to talk to you about how we think you can benefit from using IBD within your portfolio or within your practice, and how you can differentiate using IBD. Chris and Justin will spend some time talking about our newest ETF that we launched with them. They'll be talking about the underlying index, the IBD ETF Leaders Index. And finally, we'll conclude with a few of those timely ideas that I had mentioned earlier, and why we think IBD strategies are best owned within the ETF structure. So with that, I will pass the call over to Chris and Justin.
Thanks very much. This is Chris Gessel at Investors Business Daily, and with me is Justin. Justin, why don't you kick it off?
Okay, well, let me just start by giving everyone a little sense of who Investors Business Daily is. Investors Business Daily was founded by William O'Neill back in 1984, but as Graham suggests, that's not where he got his start. You know, he had been at this game for quite a while, starting in the late 50s as a stockbroker. His goal was to make money for himself and his clients, and with his early success in the market, he opened up his own institutional research firm in the early 60s, and he really revolutionized the industry by using a computer to help analyze data. Now, of course, back in those days, early 60s, computers were not on everyone's desk, so that was he was really a pioneer there. He eventually turned that company, William O'Neill and Company, into a premier provider of research. So now in starting the paper, Bill's goal was to bring some of that powerful research to the retail investor and help them achieve their financial goals through investing in the stock market. And that really continues to be our mission statement today, helping our customers make more money in the stock market. And to that end, we're constantly creating new tools and features based on that research background. You know, we have kind of a saying, we're always in beta here. You know, we're always trying new things, you know, using research. We're using computers to help objectively assess stocks with ratings, screens, and all sorts of tools that make our investors smarter, more successful, and save them time. Now, our strategy is really unique. What we use is really a proven, fact-based system with rules for when to buy and sell stocks. Now, the selling is absolutely critical and not something a lot of people address. With rules, our belief is that anyone can achieve financial freedom with a diligent execution of these rules over time. And so our data, it goes back to the 1890s, and we tend to look beyond just the market as a whole. We really want to look at the particular subset of what the best performers look like. And you know, to that end, that's what our products are really designed to do. Find those stocks with similar characteristics and the ones that have the most potential. So Chris, why don't you talk a little bit about what makes us different?
Well, it really comes down to when we look at the market, we're looking for strength, and we're looking for strength not only technically, but in fundamentals. So we want big earnings growth, great sales growth, high return on equity, all those fundamental factors that power the big winning stocks in every cycle. And then we put that together with technical strength. And we have a number of ways of measuring that. And really, when you put fundamentals with leading stocks that are outperforming the market, that's where you get this extreme outperformance. And we, in all of our lists, our indexes, it really comes down to we're letting money flow to where the strength is. And so every time we rebalance, we want to take the weaker names out and put in the stronger names. And we're always looking for the leaders. This allows us to really have conviction on relatively few stocks. When it comes to the IBD 50, that's 50 stocks out of 8,000 that the only 50 that pass our screens and rank the highest. And so we're making a very, you know, focused bet on what we think is the best leadership in the market at any one time. And so since we're looking for stocks that are ideally making new highs or breaking out and beginning their major moves, we're not looking for stocks that have been breaking down and are in their own bear markets. We're looking for strength. Everything that we're doing here is rules-based. It's based on the work that was pioneered by Bill O'Neill and continues to this day at IBD and our sister firm, William O'Neill, the research company and broker-dealer. And really, if you've got rules, then you know what to do when things get crazy. And the last couple days were perfect examples. There's, you know, stocks falling all over the place. We run a couple of stock picking services as well. One had 0 stocks in it because of our rules got us out before the market started falling, and the other one is more of a intermediate to longer term portfolio. And we made some adjustments, but we didn't run in and sell everything all at once. It was all based on, okay, this stock is breaking a rule, it's breaking a sell rule, it needs to go out right now. Now, when we take this theory, we take these rules, and we put it into practice, at least with the IBD 50, we've been publishing that in one form or another since 2003. And so this is public record. It goes back, this is stocks that have been published in the newspaper and our website every week going back to 2003 and tracking them with a weekly rebalance. And the performance is obvious. We've doubled the S&P's growth rate during that time. It does have more ups and downs, but overall you're getting a lot for that volatility within this index. And we turn this into an ETF. Bruce will talk more about why it works as an ETF, but it's been tracking this index in real time since 2015, correct? So it's a good historical record, obviously. Now, if we have this kind of outperformance in a lot of our indexes that we publish throughout the newspaper, and we focus on different areas of the market. But here's a few of them, and the top one is sector leaders, and that's something that's a very restrictive list, and it's looking for the best of the best, and it really shines. It's up 696% since we introduced it in 2009. So again, all this is rules-based. No one's making calls intraday, day by day. The work goes into the program, and we might refine the program, but we're not jumping in and out of it and trying to do things as in the heat of the moment.
Yeah, and any changes, usually have to undergo quite a bit of testing and discussion amongst the team. This is a change we really want to do, and those changes are very, very few. But as you can see, these numbers do reflect all of these lists that we're talking about here are published in the paper. And so this is the performance. We went back to March of 2009 because that's when some of these started. So just to have an apples to apples comparison on those. But some of these lists have actually been around much longer. Like the weekend review. That was one of our first lists, I believe.
Yeah.
Started in maybe the late 80s or early 90s. So a lot of these lists have a very long history behind them of outperformance.
So let's pass this back to Innovator.
Great, thanks a lot, guys. The next section, I'll turn it over to Bruce Bond, and Bruce is going to give us some insights. We've seen a lot of strategies in our time, and Bruce has, in his time at PowerShares and Innovator, decades in the ETF industry, seen a lot of strategies. And I think he's going to spend some time talking about what makes IBD's approach unique and how you can apply it to your practice or into your portfolio. So, Bruce?
Thanks, Graham. Thanks, guys. Thank you, everyone, for tuning in today. I think I'll just start by saying I think now is a great time to get involved with the 50 and with leaders. What we have seen is that securities that have the greatest momentum going into a correction or a sharp downturn in the market, when the market turns around and heads up, tend to lead on the way out of that correction and really excel as a bull market takes hold. And I don't know where you guys are at, but I tend to believe that over the next couple years here, we're going to see a very strong market. I mean, obviously, we'll have its ups and downs, but I think we're going to have a growing economy and a lot of opportunities in the market. And I think that both of these strategies are a great way to take advantage of that. If you're a relative strength or a growth investor, these are some great products to use. And I just want to walk through with you a little bit why I think they're really a terrific opportunity and why an ETF fits them well. And some of the things we're going to walk through is that, they're time tested and that they're high conviction. Those are important things. And, you get this really pure, aggressive exposure to relative strength and growth. And what I mean by aggressive is that, these rebalance on a weekly basis, and they're doing everything they can to include the stocks that should be included and to exclude stocks that shouldn't be in there. And that's something that you should note. If you're really looking for exposure to growth and momentum, you need to have things that turn over fairly regularly in order to access those stocks, because they move in and out fairly rapidly at times. And just to talk to you about using this versus an active manager in these types of approaches. So as we move on, why does their approach matter, and why is it really good for investors? And the guys at IBD reviewed some of this, but I think the key thing to take from this chart on the left, William O'Neill, if you've been in the industry for a while, he is a pioneer of quantitative and fundamental analytics going way back. And most of us that have been in the business have heard his name for a long time. Thousands and thousands of investors have used their methodology to make money through time. And there's a lot of advisors and investors that really love the IBD approach. The inception was back in '84, and you can see that they published a list since 2003. I think the very key thing here is to note that these lists, as Chris said, were published in real time. This is not something that was, there was some kind of a algorithm or some type of a back test that was created through time to come up with the amazing charts that they showed you earlier. These are selected in real time. These are real life performance results. And to be able to take advantage of something like that in a package that can protect you, I think is pretty compelling. If you compare to what they've done, since they've been publishing over the IBD 50, you can see it's, they turned $100 into $1,800 and versus the S&P and $440, and that's a significant outperformance. Another thing to think about here is that the CAN-SLIM methodology that IBD incorporates for the 50, it looks like, all listed securities in the market for the most part, 8,000 listed stocks, and it breaks those all the way down, looking at all the different facets, using the methodology just to pull out the 50 stocks that have the highest ranking for growth and momentum in the marketplace, kind of looking at the fundamental side as well as the technical side to pick the stocks that have the greatest potential at that moment to outperform over the coming period. And I think that significant narrowing and that, all-in approach to owning the correct stocks is the key. What you find a lot of times today in asset management is that these managers don't have to disclose what they own on a daily basis, and therefore they become closet indexers to protect themselves and to kind of get close to whatever benchmark they think they're being compared to. IBD has never done that. They've announced this list on a daily basis, and you can see exactly what their stock picks are, and I think that's why they have so many people that are looking to participate with them. As we move on to the next page here, one of the things I want to point out on why their approach matters is to contrast them to some of the other ETFs in the market that seek to provide exposure to relative strength or growth investing. And everyone is familiar with these different ETFs. They've raised significant assets over the last several years, but I really think IBD stands head and shoulders above these. And the one point to look at is how often they're rebalanced, and then secondly, the amount of rebalancing that occurs in the index and thus in the fund as the fund replicates the index. Over 2017, over the last annual period, the ETF turned over 1,041%. That's a massive amount of turnover, and that's because it's rebalanced weekly, and it is including the stocks that they have the greatest conviction are the ones to own, and they're also getting rid of the stocks that they don't have conviction about. And I think it's important to note that the ETF, a lot of people think that ETFs are tax efficient or low cost because they're based on benchmarks, and that just isn't accurate. I mean, ETFs are tax efficient because of the structural elements of an ETF, which allow them to transact their business in kind, in stock, rather than having cash come in and out. And I'll talk about that a little bit more in a minute. But I think that some of the things that make them compelling is the amount of turnover and how they aggressively seek to include the best stocks in there on a daily basis. Just moving on here, I think I referenced earlier that stocks that have the greatest relative strength moving into a downward period or a correction also are the stocks that have the greatest performance coming out of those periods. And we've actually been through a period similar to that over the last couple of years, whereas IBD, when it came out, it kind of went sideways and then had a little trouble into February of 16. And you can see that in the chart to the left. When growth was out of favor, the market had a little more volatility in it. But then once that stopped and turned, and once people started to get optimistic about the changes in the economy, some of the things that were being done from a tax perspective, and we all saw the economy turn around. And you can see how growth, when it came into favor, how well the 50 did. In fact, over that period that's shown there on the right-hand side of the page, from February of 16 through basically current, the IBD 50 was up over 80% in that period, far exceeding the performance of those other competitors that we showed you. And that's why we think if you truly want growth and outperformance in your portfolio, that this is a great thing to have as a portion of your assets. As we believe that, the market here just had a little shakeout. This looked to us like just a typical bull market shakeout where they were just shaking some of the dust off and maybe got a little overdone, hitting a new bottom, and that we're going to move up from here is what we believe. And we think the 50 is a great thing to participate in with that. One of the things that I've talked about for a long time is the outperformance of ETFs generally over active managers. And I think the important thing to consider here is that usually I do that because I think that there are structural reasons that this happens. It's not just that really mutual fund managers can't pick good stocks, although, if you look at the results of some of these studies done by S&P, that we have the active managers underperform here on this chart, it looks like none of them can outperform the indices, or at least none of us would bet on it. And what I would say is that there are some really key components to consider there. If you imagine yourself, you're a mid-cap portfolio manager of a mutual fund, and you've held that, and you have some positions that have done very well and built up really big gains within your portfolio. Well, you really have trouble selling those off when it's time to sell them off, because if you sell them, it's going to trigger a cap gain for the rest of the portfolio. And so what they have to wait for is if they have some other losses to offset against the gains, and it becomes difficult to manage that tax position. So what happens is they have to manage toward taxes more than just strictly for performance. The other thing that they have that is that is a structural benefit for ETFs versus a mutual fund are the transactional costs. In an ETF, when the fund is growing, how an ETF operates is we receive the underlying stock and we give them the underlying stock. We don't get the money in cash and then go back out and buy the securities in the open market. In a mutual fund, when you want to buy shares of a fund, you send them cash, they take that cash, they go out and buy stocks. Well, there's transactional costs, there's slippage in the market, there's all these issues that come into play when you do that. In an ETF, the portfolio is known by everyone, and they give us that portfolio of underlying securities, and then we give them shares of the fund back, whereby creating additional fund shares or ETF shares in the market. That eliminates the transaction cost of going out and buying those stocks and allows us to have higher turnover at lower cost. The other thing an ETF doesn't have that goes along with this in-kind creation redemption process is that we don't have like small dribs and drabs of cash coming in that we need to get invested in the underlying securities. We get large blocks of stocks that come in and go out, and we exchange that for shares of the ETF. That is how an ETF grows. Because of that, it makes it super efficient and very low cost for investors, regardless of the amount of turnover. I know this is kind of complicated. I only go through it to just iterate and backstop this position that I'm telling you that ETFs are very low cost and tax efficient, not because they're benchmarks, but because they're ETFs, and there's a structural benefit there. One of the things I think is important here, I used to use this analogy down south all the time, if you like NASCAR. If you think of NASCAR, they all basically have the same engine in the cars, and so all the cars have the same power. If one of the race companies has a transmission that eats up 10 or 15% of the power before it gets to the rear wheels, where another company can just send that power seamlessly down to the rear wheels, then obviously the company that eats up less of that power on the way to the track is going to beat the other company. That is very similar to an ETF. An ETF is very efficient, sends that performance back to the investor in a very seamless process, whereas mutual funds have a tougher time doing that because of the transactional costs and some of the older structural issues that they have. Because of all these things put together, I believe that considering the 50 and the leaders in today's market can be a real benefit to investors, and something that you should consider maybe looking at some of your mutual funds that you might have mid-cap or large cap or global funds and swapping those out for either the 50 or the leaders portfolio. So thank you for your time, and with that, Graham, I'll turn that back over to you.
Great. Thanks a lot, Bruce. Really appreciate that. Always enlightening to hear an update on active managers' performance, but also the structural efficiencies that ETFs provide. With that, I will pass it back over to Justin and Chris to help give us or enlighten us on their newest index, the IBD ETF Leaders Index. And before I turn it over to them, I just want to remind people that we did bring an ETF that tracks this index to the market in late December of last year. So the ticker on that ETF is LDRS. And with that, I will pass it back over to Chris and Justin.
Thanks, Graham. Well, a number of years ago, I had this idea of, well, what if we put IBD'S analysis to the ETF market and try to find the best ETFs and create buy and sell rules around them, and basically put IBD to work in that universe. And so Justin and I and other members on our team, we started working on this and coming up with different rules, and we discovered that we could put together an index that over the long term vastly outperformed the broad market. And it was kind of interesting because it did it in different ways. It's not simply waiting, for growth to be in phase. It can go anywhere in the ETF realm. Basically, the only thing that matters, there has to be some minimum price, volume requirements. There has to be enough assets that we don't overwhelm the ETF, and it has to trade in U.S. markets. But other than that, it could be stocks, it could be bonds, it could be country funds, sector funds, really anywhere that the market is shining and ETFs are leading, that's where we're going to be going. Now, we don't use inverse and we don't use leverage funds. There's only a limited bit of commodities in at least Justin is saying no now. I guess not anymore. Never mind. So the way we go about this is we screen our universe each month, and we're looking for the ETFs that fit all the criteria. And it ranges, I mean, it could be as few as like 3 ETFs and
at least 3.
Yeah, at least
we'll always
3.
have at least 3.
At least 3 ETFs, and I think right now we're around 20 or
25, which is actually pretty high historically.
Exactly. So while there's fewer, I guess, securities in the form of ETFs in this than maybe we would see in the IBD 50, of course, there's a lot of securities within each of those ETFs, so there's quite a bit of diversification as well. So, like we do with the IBD 50, if we go to the next slide, it's unemotional, it's objective. We're not making choices in the moment. It's all programmed ahead of time, and we know that these are the criteria that have delivered results in our historical data going back many years. Again, we're not beholden to any one ETF issuer. We can go anywhere in the market, any sector, really bonds and stocks, whatever it may be. And actually the bond element is kind of interesting because we don't really need any sort of market timing with this to deal with a major bear market, because what happens is when the market gets weak, the bond funds rise to the top. And Justin will show a little bit about how that worked in the past. Just like with the IB 50, we're always each month removing the weaker ETFs and replacing them with stronger ETFs. And the great thing is, as the market for ETFs has expanded, our choices have expanded, and there's just so many more opportunities out there.
So if we talk a little bit about what the potential benefits of the index are on the next slide here. First, the index is rebalanced monthly, and it's very different from the IBD 50 in that regard. The IBD 50 does require more responsiveness. So the weekly rebalance is a critical component of that. The ETF leaders, we actually did a number of different passes at it, and it actually works better with a monthly rebalance. And part of the reason is that mean reversion that happens in ETFs, because it's got a little bit greater diversification. There is more of that mean reversion, and so we do factor that into our rules for this. Whereas with a lot of our stock lists, that's not the way we approach things with individual stocks. It's definitely with the ETF leaders is a critical factor. Profit-taking rules, as I mentioned at the outset, sell rules are critical for many of our strategies, and the same is true of our ETF leaders. So we do use profit-taking rules, and they significantly improve index performance. That's another aspect of that mean reversion. When something is getting a little, ahead of itself, we do some profit-taking. We also have special market event rebalances. What those do is, sometimes you need a little bit more responsiveness than the regular monthly rebalance. So if there's a critical change in the market, it will trigger a market event rebalance, and that's usually to get us in to what's working if there's a market change. We don't want to wait until the end of the month if that market change happens at the beginning of the month. So
typically those happen near major market bottoms.
Right, exactly. So that's where it becomes really critical. And the fact that we're really using that combination of the relative strength and the mean reversion, it really does create a very unique strategy. And we get names that we're not normally, things that we're used to. We're very focused on growth for most of our lists. And one part of the story that Chris neglected to share was that he was the original guinea pig. He was doing this in his own portfolio, trying to figure out how to get some outperformance using ETFs. And every now and then it would be one of those things where it'd be like, he established his rules, and wow, look at what I'm in now. This is different. This is unusual. And that kind of highlights that go anywhere approach. We're going to follow that strength wherever it may lead us. And because we don't have the fundamental characteristics that we're looking at for individual stocks, and again, that's important when you're wanting to find individual stocks that have the potential to be the best performer of the market cycle. However, with the ETFs and that greater diversification, we can kind of go anywhere, and sometimes that does lead us into sectors that we wouldn't normally be in because the fundamentals aren't there, especially cyclical names. Sometimes it's the gold miners or the oil or what have you, or chip stocks. Yeah, solar. Things that are maybe some up and coming sectors that just don't quite have the earnings there yet. So just to kind of take a look at what we did recently in terms of the rebalance, you can see that in January, what we were holding, there was a strong U.S. equity exposure. We have some global exposure as well. Specifically, China was something that had been a part of the ETF Leaders Index for a while, and it kind of shifted at the end of the month. It actually broadened out into more names. The U.S. exposure reduced a little bit, and some other country exposure got introduced, including Greece and South Africa, Thailand, Austria. So some countries that we didn't have before. We got some extra exposure to those, some emerging markets, and this is something that we see again change. Just depending on what the market is doing.
Right. You're not always going to find emerging market or country ETFs in here. Sometimes it might be heavily weighted in technology or internet or just U.S. equities, and then things change.
Yeah. And there is still, in this February, there's still an internet technology bent here. In fact, like Robo was one of the holdings, the robotics and automation. So yeah, you really do get exposure to some interesting areas. And given what we've seen in the last couple of days, okay, if we bounce back from here, you'll probably see some very similar names remain in the index. If we weaken from here, you're probably going to be looking at a very different index come the next monthly rebalance. So speaking of which, if you can go to the next slide.
So let me tell you a little bit. We've talked about relative strength as we apply it to the IBD 50 as well as the Leaders Index. And IBD's relative strength rating, we look at the price performance of every security on the market over the last 12 months. It's weighted more heavily to the recent quarters, and it includes all the equities on U.S. exchanges, not just the ETFs when we are applying it to the ETF leaders. And the rating itself doesn't have mean reversion, but we do look at that in terms of the percent change in the performance of an ETF each month. And we want to, as Justin was talking about earlier, when they get ahead of themselves, we know it's highly likely that they're going to pull back, and so we want to take profits before they pull back. Now, ETF leaders, the history, we have historical data at IBD. We started publishing this live in the paper in February of 2016, and we've been writing articles on it. If you do take the paper, you come to the website, you might notice slight differences between what we publish and what's actually in the list, and part of that is the profit-taking rules, but it's also, we don't want to tell everyone exactly what's in the list and have any sort of front-running issues. But you can have a real, good idea of what's in the universe, in the final selection universe each week by looking at the paper.
So let me just talk a little bit about how this index handles a correction. This was a question that we were getting from a number of our own subscribers, and asking a little bit of how it would work in that regard. And so what I did was I kind of took a look back at the 2008 financial crisis. What the makeup of the index was at that time, and it was actually very instructive. It kind of started, there was definite weakness early on in 2008, but things really got ugly in September and October. That's where the panic kind of set in. Now, the ETF Leaders Index was kind of invested at that time with a heavy biotech weighting in September, and that shifted 33% weight to bonds by the end of the month, and 100% in bonds by the middle of October. And again, that was a special market rebalance that occurred because of what was going on. So whereas October was the worst month for the S&P 500. This kind of cushioned the blow, for the ETF leaders because of that shift in exposure due to the market rebalance. That bond exposure actually remained until March of 2009. And then what the ETF leaders started doing was it started to actually shift to some of the index ETFs, the SPDRs, SPY, IWM that represents the Russell 2000, and the Qs, the NASDAQ 100. And because at that moment it was kind of unsure who the leadership was going to be, that was the reaction of the ETF leaders index, and it held those things for quite a while. And whereas the IBD 50, kind of struggled a little bit at the outset because growth wasn't in favor. If you remember back in March 2009, it was all these things bouncing off the bottom. It was
Ford going from 2 to 15.
Right, exactly. Citigroup, was $1, and it, oh look, it doubled to $2.
Right.
So that was really driving a lot of the performance in the indexes, and growth wasn't really taking part in that. And so the ETF leaders had a very different performance number than the IBD 50 did in that time frame. 2009 was actually one of its best years, whereas it was a very so-so year for the IBD 50 because growth really didn't start coming on until July. So it's kind of funny how these indexes do work, and they kind of get to the same end goal almost in very different ways. So Graham, why don't you talk a little bit more about what's going on with the ETF?
Yeah, great. Thanks a lot, Justin. And to Justin's point earlier, we'll spend a few minutes in a couple of slides talking about how you can combine FFTY and leaders, how you can combine the IBD 50 strategy with the ETF leader strategy. And I think you'll see that they're very complementary of one another. I wanted to spend a couple of minutes just talking about why we chose to bring the ETF leaders to market. The leaders is an ETF-based index, and so to build an ETF, we were essentially building an ETF of ETFs. The reason why we did that, and I think one of the most common questions we receive is, why don't you just buy the underlying stocks or the underlying bonds of the things that IBD is saying are in favor? Aren't you just adding a layer of fees by selecting and owning other ETFs? And our response to that is twofold. Really, for a strategy like ETF leaders, which is a truly high turnover, very tactical, go anywhere strategy, an ETF of ETFs is actually more cost effective than going out and buying the individual stocks and bonds for a lot of exposures that we receive. A good example is high yield bonds. If IBD's strategy were to select high yield bonds 1 month and then the next month sell out of that, the cost of owning and assembling a basket of high yield bonds would be very, very expensive. And instead of buying the individual bonds or selling the individual bonds, it's far cheaper to just own one high yield bond ETF and then sell it at the end of the month. Another good example is within the emerging market space or frontier markets. To be able to get in and out of those local stock markets on a very timely basis, it's often cost prohibitive. So from a cost standpoint, just from a trading standpoint, an ETF of ETFs is actually very cost effective. Not to mention the taxes. Bruce alluded to this earlier, but an ETF of ETF strategy has the same in-kind benefits that Bruce discussed with regards to the IBD 50. For a go-anywhere, highly tactical strategy, you want to be able to have the in-kind transfer mechanism working in your favor. Again, at the end of the day, what you take home are your after-tax returns. And so an ETF of ETF strategy helps maximize tax savings. From a market breadth standpoint, we wanted to ensure that we're providing IBD followers purity of IBD research. We wanted to make sure that IBD was able to select from the broadest universe possible. And the beauty of ETFs today is that they provide exposures to areas of the market that are A, very difficult to access, but B, they provide exposure to very targeted areas of the market. Earlier, Justin talked about some of the single country ETFs that we had exposure to, or the robotics and artificial intelligence ETF. Being able to get access to those exposures through the ETF, again, is far more efficient than having to assemble the underlying baskets and then having to buy and sell those over time. And so as we look at the ETF leaders, we think it's a great complement to maybe what you're doing in your strategic portion of your portfolio. And again, the fact that this is all managed for you in a single ETF, highly tax efficient, we think makes it a compelling complement to what you're doing. Moving on to the next slide, this last section that we want to spend a few minutes going over before we talk about some of the questions that we've had come in. Why does an IBD strategy make sense within the ETF structure? I think there's really three reasons why it makes sense to own the IBD strategies within the ETF structure. The first is that it's a single ticket solution. And by single ticket, I mean that you can buy an ETF like FFTY or LDRS on an exchange through your brokerage account or through a financial advisor, and you can own the IBD 50 lists and the ETF leaders lists. The ETF makes all the transactions for you. It handles all the rebalances and that high turnover that we talked about without you having to worry about it. The tax efficiency, the next slide will go into a little more detail on this, but we can't emphasize enough the importance of the tax efficiency that ETFs provide investors. For strategies that have very high turnover, you want to own those strategies in the ETF structure because it allows you to defer capital gains to when you sell ETF shares, as opposed to buying and selling the stocks or ETFs in the IBD list yourself. Each time you do that, that's a taxable transaction. And highlighting again what Bruce talked about earlier, that the tax efficiency of an ETF is fully independent of the amount of turnover that the ETF experiences. Finally, the third part is very practical. We've often hear from IBD users that it's often very challenging to manage a list like the IBD 50 because of the amount of turnover, because of the amount of time it takes, because there's slippage in their transaction costs. Again, that's what the ETF does for you. I think it helps you save a lot of time. We handle everything for you. And from an implementation standpoint as well, we find that these are perfect for people that have smaller accounts, for people that maybe want to be in a managed portfolio that has higher minimums. The ETF strategies that we have with IBD are great solutions to fill that void. So moving on to the next slide, again, not to belabor the point on ETF tax efficiency, but Bruce talked about why the in-kind mechanism allows us to defer capital gains to when you as the investor sell your ETF shares. The point I want to highlight on this slide is actually refers to an ETF that Bruce built back in the day at PowerShares in 2003. And this ETF, since its inception, has averaged over 200% turnover each year. And despite that, it has never made a capital gains distribution. And so I think that that's a good highlight for the last 15 years, although it's been a relatively high turnover strategy, not as high turnover as FFTY, but I think what this highlights is that, again, the tax efficiency of an ETF is independent of the amount of turnover that an ETF experiences.
And it's maintained pace with the S&P over that period too. So
Exactly, and that's a great point, Bruce. Oftentimes you'll see a comparison of an ETF to a mutual fund, but it doesn't take into consideration the after-tax returns. And again, that's what you end up taking home as the end investor. And I think that's something that's very important to emphasize. Moving on to potential applications. Justin, I'm going to turn this slide over to you, but I know we've gotten a lot of questions since we brought leaders out. Is how do you combine IBD 50 and the IBD ETF leaders?
Mm-hmm. Yeah, thanks, Graham. So first of all, I just want to say one of the great things about this partnership between IBD and Innovator is that, considering taxes has never been, a component of IBD's strategy. Our focus has always been on performance. And so one of the things that's great about this partnership is we focus on performance, and we let you guys at Innovator take care of the mechanics of making it tax efficient, transaction costs, all of those things. So it's really very refreshing to just be able to focus on that performance part. We'll focus on what works and everything like that, and we let you guys worry about that complicated part, so all the in-kind transactions and everything. So let's talk a little bit about the IBD 50 and IBD ETF leaders as a combination. And I mentioned this earlier. One of the things that we found in looking at this historical data is that the two strategies really involve getting similar returns, but the way that they do it is very differently. Sometimes you'll have, like in 2009, where the ETF leaders had a phenomenal year, and IBD 50 was I think beating the market, but not particularly strong. You turn over to 2017, and IBD 50 really hit it out of the park in that year. ETF leaders, because of a lot of sector rotation that was going on, the weekly rebalance of IBD 50 really helped it stay in phase, whereas ETF leaders, was dealing with some movements that were a little bit tougher. So IBD 50 was the place to be. So rather than kind of try and guess and pick which one is going to be the winner for a particular year, a combination of both really does make sense. And again, the ETF leaders will get you exposure to things that the IBD 50 doesn't necessarily get you exposure to. The IBD 50 right now, it does have some global exposure. Mostly China, but a little bit in UK and Argentina. But the ETF leaders has a lot more of that global exposure. So again, if you look at the historical data, the returns do get to be very similar. Even the volatility of both of them are pretty similar in terms of the standard deviation, but they do achieve those results differently. In different years, one will well outperform the other, and they kind of take turns almost sometimes. Mm-hmm. So that combination can really kind of smooth out your overall returns, and actually it smooths out some of the volatility of each as well. Did you have anything that you wanted to add on that, Chris?
No, it's just been remarkable because in general, when growth is out of favor, it seems that the ETF leader steps up, and so there's just not too many times where both would be out of favor, and we've seen plenty of examples like last year and 2009 where one is still up and doing okay, but the other one is doing fantastic, and it's like Justin said, it's a good way to get to the same place but on a smoother path.
Great, thanks a lot, guys. Yeah, no, thank you. And I think one last thing that I would iterate on this slide is, I think maybe to summarize what you guys just said, I think the key difference is that IBD 50, it's a stock list. It provides you exposure to the 50 highest growth stocks, but it only invests in stocks. The ETF leaders allows you to move between asset classes and across geographical boundaries and into fixed income and alternatives, something that the IBD 50 is just, it doesn't do. And so I think because of that, because of the different asset classes leaders can provide exposure to, I think that highlights how the two really can complement each other very well. And the last thing I'll say on leader is, we often hear about relative strength, but we don't hear a lot about mean reversion. And so I think the fact that IBD uses a combination of relative strength and mean reversion is something that is pretty unique within the market today. So moving along real quick, we got some questions piling up that we want to get to. We said we were going to just talk about maybe a timely idea. And so what we've done here is given a look at historically what's happened when the market has had pullbacks. And we've provided 4 real-life examples of when the IBD 50 has had pullbacks with the market. And the common theme that we have seen is that following market sell-offs, the IBD 50 tends to have very strong performance going forward. Again, it's a higher beta investment. And so although it may underperform in some down markets, it has a very strong propensity to outperform following the corrections. And so, we're here to help support. What we found is following these corrections, it may be a good entry point for people that have maybe been on the sidelines for a little bit. We also find that moving averages have been very valuable for some of those investors. So feel free to reach out to us here at Innovator. We're happy to walk you through some of those things that we found as well. So following the pullback, just an idea to look at some of the IBD strategies like FFTY and LDRS. Finally, the last slide, just to summarize really what we've talked about today, that FFTY and leaders may be relevant to play a market rebound. They're perfect for taxable accounts. Again, we can't emphasize enough the tax efficiency that ETFs provide for smaller accounts and accounts that you're afraid of putting into some models that have higher minimums. The ETF works really well. And then going back to what Bruce said about the growth and relative strength exposure, I think that for those investors, and we know many of them who are believers in growth investing and relative strength investing, if you want pure growth exposure or pure relative strength exposure, I think FFTY, for example, is a great way to get access to that. 50 stocks, rebalanced every single week. The high turnover is managed for you in the tax-efficient ETF vehicle. If you're a believer in relative strength and growth investing, we highly recommend you take a look at both FFTY and leaders. And so with that, we got a number of questions here. I'm going to ask a few of them, and then the questions we're not able to get to today, we'll be sure to have an Innovator representative get back to you following the webcast. So the first question I'm going to ask Bruce this question is, I track the IBD 50, one of the advisor has written in, why should I buy the ETF and pay the expense ratio? Doesn't it just make more sense for me to buy the IBD 50 on my own?
I think what I would say with that is, I would highly doubt that. And the only reason I bring that up is, first of all, I know that those 50 stocks can be difficult to acquire. And if you try to do that on a daily or even a weekly basis like the index does, with 1,000% turnover, there's going to be tremendous amount of transactional costs that you have to pay to do that, even if you're paying smaller fee amounts. And then secondly, the tax cost. I mean, I think, we've kind of, beat that drum a little bit today, but you have to look at tax as a cost. And because at the end of the day, it all reduces the amount of take home that you have. And the other is slippage in the market. You got a transaction cost, you got tax, and then you have slippage, where you're trying to get the deal done where you want to get it done, but it's moving away from you. I think the ETF, by and large, does a very good job at providing all this to you seamlessly. Now, what I would say is if you like to buy the IBD 50 and you're like, you want that to be part of what you do, what I would do is I would buy the 50 as your core, and I would own, 50% or 75% of it in that. And then if there's some particular ones within the IBD 50 list that you really like, I would overweight those. I think that's a terrific way to get exposure, own all 50, and participate. In our discussions with Chris and Justin and the group over at IBD, it seems to me like if you just try to buy the top 10, there's a good chance you're going to miss out on a portion of the performance of the 50. If you don't want to miss out on that performance because, you just happen to buy the wrong ones, then you get all 50 and then you're going to get the performance that, that tremendous track record has provided over the last, number of years. So anyway, that would be my encouragement is to look at it that way. And I think that even if you try to calculate the cost of doing it on your own, I think you would find pretty quickly it's tough to do.
Thanks, Bruce. The next question, I'll turn it over to or ask Chris and Justin. It's with regards to the mean reversion component of the leader strategy. Can you guys just, in 30 seconds, just give us a high-level explanation of what, how you incorporate mean reversion into the leader strategy?
Sure. It's incorporated in two ways. We have a number of time periods, and I think the longest one is 39 weeks, 38 weeks. And we look and see how much each ETF has appreciated in these different periods. And if it hits the upper threshold, then it will be removed. But we also do it for the entire portfolio as well, because we've seen that it too has a mean reversion aspect. And so, again, over different time periods, there are different levels of performance. And if it exceeds those upper limits, we will go to all bond funds for the rest of the month and then rebalance later. And so that one rule has proved to be really powerful, because we basically take profits across the whole ETF, and it just happens to occur near a market peak, or at least when the market is getting ready to pause. And so we essentially go to cash briefly, the market pulls back, and then we rebalance and get back in sync with the market on what's going to be leading in the next up cycle. So it's a really remarkable approach, completely different than what we do with stocks. And I'll say it was our colleague Praveen who really came up with this. And it's just an example. We all have different strengths and different ways of looking at the market, and we pull it together and really come up with some different sorts of products.
And even when you look at the results of that profit taking, sometimes maybe it didn't quite work out the way you wanted it to for that month's rebalance. But a lot of times what happens is you actually sat out of a major blip,
right.
where it could have easily shaken you out, and as opposed to going through that, and maybe you came out okay at the end of the month, but maybe you didn't, or maybe you would have sold, so kind of flattening that out, it not only reduces some of your volatility, but I think it can also, that profit taking can kind of reduce your own angst sometimes when the market gets a little ahead of itself and cracks.
Great. Well, guys, thank you so much for taking the time to join us on today's webcast. Just a reminder, there's a 30-second survey following the webcast, again, to express your opinions on what IBD strategy you'd like to see in an ETF next. We'll be trying to get this approved for a replay, and we'll be sure to distribute that once it becomes available. So with that, I'd like to conclude the webcast and just reiterate our thanks for you joining today.